Hi, this is Chris McManus from McManus Finance. In this video, I'm going to talk to you about invoice finance, how it works and how it can help your business reach its full potential. So, invoice finance is a growing business finance solution. Many businesses use it. A lot of businesses don't understand it, and some think it's the devil's work, to be truthful. It's none of those things. It's a fantastic facility if it's used properly. But as an unregulated product, it can be a little bit of shark-infested waters in terms of who you're engaging with. So it's really important, if you're going to look at this product, you work with a broker that is authorised and regulated by the FCA. Even though it's not a regulated product, you at least know that the people you're working with are going to be guided by principles of treating customers fairly. So, invoice finance, why do we have it? Well, is to deal with the age-old problem for businesses, which is cash flow. Every business is in the centre of their universe, and they have pulls and flows of cash all the time. You as your business have customers that will pay you, and you'll have costs of operating your business that are permanently pulling at your attention. These are things like your staff costs, your suppliers, your rent, your rates, your cost of operation, fuel, etc., etc. And obviously your customers are people who you provide a service to and owe you money. And the challenge for a lot of businesses is that the demand to pay their bills comes around a lot more quickly than the money coming in from their customers. So a typical situation would be a business that might be providing a service to a customer that might have anywhere up to sort of 90-day payment terms. You've done a job 1st of January, and you're not seeing that money perhaps until early April. So you've got 90 days perhaps plus where you've done a job and you've got no money for it. It's sat in your customer's bank account. That's yours, £10,000 job, let's say, and it's sat in your customer's bank for 90 days. For those 90 days, you're still having to pay all your costs, your staff, rent, rates, fuel, and all those other costs that you need to operate. And you've got all that money going out and no money yet coming in. So how do we break that cycle? With the use of an invoice finance facility. Invoice finance is a very simple product, but it can be complicated and it can be misunderstood, as I said. But very simply works this way. You do a job for your customer and you raise an invoice to your customer for payment. Now, without an invoice finance facility, you're going to be waiting however long it is, 30 days, 60 days, 90 days, 45 days, whatever, to get that money from your customer, but you've got your bills knocking on your door all the time. So you raise your invoice as normal, but instead of waiting for your customer to pay you that money and having to manage that delay, the invoice finance company will pay you 80 to 90% perhaps of that invoice amount immediately. So that cash flow comes straight into you as soon as you do the job, which means you can now use that money to pay your costs straight away. Some people think the cost of the facility, therefore, is the difference between the 80 and 90% and the 100% that you've invoiced, and that's not correct. What happens here is that your customer eventually will pay, and when they do pay, they'll be paying the invoice finance company that 100% of your invoice that you've invoiced them. And then the remaining 10 or 20% that the invoice finance company has held back gets paid to you as well. So you get your full 100%, but out of this remaining 10 or 20%, there's a deduction of the cost of the facility, which we'll go to in a moment. So in effect, using this facility frees up or releases that cash that you've got tied up over here. You're essentially providing your customer with an overdraft facility, and you're not a bank. If you were, you'd be making a lot more money, no doubt, but you're not a bank, so don't act like one. Use an invoice finance facility to release that cash much more quickly to pay your costs. Because if you don't, you're having to borrow this money somewhere else. So there is a cost there. Whilst there's a cost to this facility, there's a cost to not using it. And that cost can be in other borrowing costs, overdraft facilities. Big issue, more than a couple of percent here or there, is the opportunity cost of not having that money in your account. The contracts that you don't win, the contracts you don't tender for, the ability to scale and grow, all those opportunities are missed if you don't have that money in. And the beauty of an invoice finance facility is they can scale with you. So as your turnover increases, the volume of revenue you get will increase as well. So let's talk about the costs, because a lot of people get nervous about what the cost is. Every invoice finance company follows a very similar model, and there are two essential costs of the facility. There's a service fee that they apply, which covers the cost of operating the facility, and then a discount charge, which to you and I is an interest rate by another name, and that's a cost above the bank base, whichever bank base they decide to use, and that's essentially what the amount you're borrowing. Essentially, you're charged interest rate against that. So the quicker your customers pay, the less your charges. Rule of thumb: if you think about using an invoice finance facility, your cost of that facility is going to be somewhere between 1% and 3% of the invoice value in total. So not the 10 or 20% that's deducted when the invoice is first settled by the invoice finance company, but about 1% to 3%. So a £3 million turnover company will probably be close to the 1.5-ish% of cost of it as a facility over the course of a year. So that should give you an idea of roughly what that is going to cost you. And if you're at sub $1 million, it's going to start moving towards the 3% cost then. But obviously that gives you that freedom and flexibility to have that money in much quicker. Personally, I would recommend thinking about, if you're going to use this facility, maybe passing some of that cost on to your customers if you can. If you're not in contract, you're providing them with a credit facility at the end of the day by letting them pay in 90 days or 45 days or 60 days. So it's not unreasonable to charge maybe a percent or so, and that can offset your cost of use of the facility. So think about those sort of things. So that's invoice finance in a nutshell. It's not a complicated facility. It does get a bad reputation amongst some who think it's a funding facility of last resort. It's not anymore. Overdraft facilities are not as common as they were, due mainly to bank lending rules and the requirements that they've got to be utilising cash more effectively within their balance sheet. So invoice finance now is a far more widely mainstream funding product. It is very, very flexible. But make sure, if you're looking at that facility, you talk to a broker, most importantly, because they can help you access a wider array of lenders, and a broker that's regulated, because you know they're going to be treating you fairly. There are some operators in there who don't, and you can lose an awful lot of money by going to the wrong provider or partner in that sense. So if you've got any questions at all about invoice financing, you'd like to know how it can work for your business and help scale your growth, get in touch with us. We'd be delighted to help you. I'm Chris McManus of McManus Finance. Thank you for watching.